Live from Singapore, this is Insight with me, Haslinda Amin, a show where we dive deeper into the stories that matter with crucial context and sharp analysis. President Trump says he will impose new tariffs on Canada and Mexico starting Tuesday, dashing hopes of avoiding a trade war with two of the biggest U.S. trading partners. Trump also signing an order doubling tariffs on China to 20%. Taking effect in a couple of hours from now. This comes just as China's biggest political meeting is set to start. And markets seem to be waking up to the reality of Trump tariffs, with Asian equities tracking Wall Street lower on concerns about inflation and supply chain disruptions and, of course, potential retaliation. And we have a great lineup of guests to cover all the angles. Eastspring Investments CIO Viz Nayar will be joining us on markets. The Bank of Thailand Assistant Governor will discuss central bank policy, and we asked the Philippines' largest conglomerate how they are navigating a volatile global business environment. Well, fresh U.S. tariffs on China, Canada and Mexico are due to take effect in just a couple of hours, dousing hopes of avoiding an all-out continental trade war. President Trump has already signed an order doubling tariffs on China to 20%. He also confirmed he's pushing through with 25% duties on goods from Canada and Mexico.
On the tariffs, is there any room left for Canada and Mexico to make a deal before midnight? And should we expect those Chinese tariffs, the extra 10%, to take effect tomorrow?
No room left for Mexico or for Canada. No, the tariffs, they're all set. They go into effect tomorrow. China also had an additional 10, so it's 10 plus 10.
Canada, for its part, has announced a sweeping package of counter tariffs against U.S.-made products. While we have yet to hear from Mexico, the Global Times also says China is considering retaliatory measures on U.S. agriculture and food products. For more, let's bring in our Bloomberg economy and government reporter, Alex Vesquez, in Mexico City. Our Chief North Asia correspondent, Stephen Angle, is also outside the Forbidden City in Beijing. Alex, let's start with you. It's just hours away. What are the chances that Trump may do a reverse?
I mean, I think that we don't have many chances to reverse this decision. We think it's going to happen. On the bright side, maybe the tariff will last just a little, maybe not too much, but I think it's going to happen, and he's going to try to negotiate. We know the Mexican government is trying to negotiate a way out of this. They've been doing some efforts in security and migration, but it seems that wasn't enough for Trump. So we think now that it's going to happen. The bright side is that this could be short.
We know that the U.S. is an important trading partner. Mexico relies on the U.S. for its economic activity. As it stands now, when we see that 25% tariffs, quantify for us the kind of impact that is expected on the Mexican economy.
I mean, the Mexican economy is not doing well right now. Actually, it slowed down a lot during last year. We saw a contraction in the last quarter of 2024. So we're expecting the economy to have trouble this year. And obviously, I mean, the central bank just slashed its growth forecast to 0.6 from 1.2. Those are not great numbers. So if we have tariff, the economy could go into recession this year. Even if we don't have tariff, but the threat persists, the economy could go also into recession. So Mexico certainly needs to resolve this pretty soon, or that it's going to have serious consequences.
Alex, all three countries, Mexico, Canada, and China, have said they will retaliate to those tariffs. But Mexico has yet to detail what actions it may take on the back of that. What do we know?
I mean, the approach from the Mexican government has been pretty different from the Canadian one. We saw it a month ago. The Mexican president, she repeated today, she wants to be patient and prudent. She doesn't want to take any risk. She just wants to wait until the decision is out, too. express Mexico's, retaliatory measures or whatever they're gonna do. They have mentioned that they could hit with tariff too, but they haven't been specific about it. They haven't said anything about what kind of products or what they will do. So we really don't know what Mexico will do. The president is just saying that they're gonna wait for the actual measure and she's gonna respond. She left the door open, and Trump did also, for a phone call between them. And the last time they reached a last-minute deal, we think that that's still possible. She's been pretty good negotiator. She sent the Mexican team to the U.S. It seems that negotiations are going well. So a last-minute deal could be possible. I mean, it's very late now. We don't think it's going to happen, but it's not completely ruled out.
It's also about a balance, I suppose, to prevent further tariffs from the U.S. Steve, let's get you into the conversation. It's pretty much signed, sealed, yet to be delivered, well, soon to be delivered to China.
Yeah, and I think what we're waiting for now are details of what the Ministry of Commerce put out in a statement earlier today. Actually, as soon as the business day began here at 9 o'clock in the morning, we got that statement from MOFCOM essentially strongly opposing the latest increase in tariffs from the Trump administration on Chinese goods, from 10% up to 20%. And that's not sitting well with the top leadership, obviously, in China. There have not been a lot of high-level discussions between Trump and Xi Jinping. There's been back-channel, talks, obviously, possibly from the Chinese side to mitigate the potential level of tariffs, because we know that Trump threatened upwards of 60% across the board on the campaign trail, so leaving a little bit of room for negotiation. But the back-channel communication and the rumors are that there wasn't really a lot of engagement to mitigate that. And hence, the White House has gone forward with that doubling of the tariffs to 20%. The question now is what countermeasures that Ministry of Commerce here has threatened now in that statement, what will they be? Because they didn't list them out. We know in the first trade war, they targeted a broader swath of U.S. goods. But again, there cannot be a like-for-like tariff, because America buys more than 3 times as many goods from China than the other way around. So we'll be looking at, in addition to maybe some agricultural products that China does need for its own economy, we're talking soybeans, wheat, corn, and other ag products, but also rare earths. There could be more export limitations and controls on key minerals. We did see a few weeks ago, after that first 10% tariff was placed by the Trump administration on China, tungsten-based minerals were included on the export ban list by China. We also saw some 80 products worth only about $14 billion of American goods also tariffed, mostly agricultural products like tractors, also LNG, liquefied natural gas. So there are other products, there are other steps that China could take. But again, we haven't gotten the details yet.
The question really is what impact it will have on China's economy. According to some calculations, the export to the U.S. account for only 2% of its GDP, so perhaps the impact could be limited.
Yes, but again, the main narrative here at the National People's Congress, which begins today, this afternoon, we get the advisory body to the NPC, the CPPCC. They'll be talking about it. It won't be part of the broad communication channels. They'll talk about the external environment is becoming more challenging and the like. We'll leave it to Ministry of Commerce to really attack those Trump tariffs. But really, the common narrative here is going to be how to boost domestic consumption. What are going to be the available markets for what a lot of economists have said is industrial overcapacity? Because let's face it, the Chinese, as they went through the crackdowns on the platform economy, on property, and obviously COVID, they really up their game in the industrial space and in high tech as well. But exports have buoyed the Chinese economy even through this downturn. So if those exports to places like the United States, also Europe and other places where they're seeing some tariff action, they do need to boost domestic consumption. That would be the most obvious available market for Chinese goods and excess capacity.
And of course, we await to hear the messaging from that NPC meeting. Our Chief North Asia correspondent Stephen Angle and Bloomberg economy and government reporter Alex Vesquez in Mexico City for us. Thank you so much for your time today. Well, joining us now is Viz Nayar, CIO at Eastspring Investments and manages about $270 billion in assets globally. Viz, good to have you with us. Timely conversation to be had. It's quite surprising that markets are actually reacting to the tariffs because they knew that this was coming, and yet they underpriced perhaps the possibility of it actually happening.
Well, I think post the election win, really the journey for markets, there's been a lot of uncertainty, and undoubtedly people have been waiting for something a little bit transactional and perhaps something a little bit more concrete. So I think I was listening to your reporters just now. You know, we still have uncertainty on whether it'll be enacted. There's a clock countdown that you have on screen, 1 hour to go.
But Trump has said there's no turning back. This is happening.
Of course. So I think that he's been very clear on the election, and that's the story that we have. As investors, we've really commented on volatility as being the one certainty for 2025. So again, as investors, I think it's key to focus on the things that we think were resilient. So diversification, thinking about trying to focus on the domestic consumer. So again, Stephen, your China correspondent was talking about how they might be able to boost domestic consumption. So as active investors, that's really been our focus this year. So I think the market action is very clear. We're seeing some more sort of concrete news from the president about tariffs, but as investors, our job is to sort of try and work out how we should be positioned.
Interesting that you said that as investors you focus on what's resilient. For a very long time, in fact, till now, people think Max 7 is resilient. The U.S. exceptionalism story is resilient, but there are doubts.
Well, as investors, I think we also would recommend looking and considering valuations. So when we think of diversification, people are often thinking beyond the Mag 7, thinking about the broad U.S. economy and, of course, opportunities elsewhere. So I think in the last few weeks we've seen some very, very strong price action in the Chinese AI post DeepSeek. So I think it's very much looking at valuations, focusing on long-term returns and trying to make sure that you're diversified. So I think actually that's very consistent.
So how does it work? How should your portfolio look like? So as it stands now, if there are risks with the Max 7, do you not buy anymore, don't buy the dip, but you buy the Chinese tech plays?
I think as a global investor, one wants to think about the global economy. So as a valuation...
How should it look like? What would you be picking up?
Okay, so if we think of actual investors and things, so you've got the Mag 7, think of them as a discrete, as a particular investment ploy. The larger economies, the domestic fakers, think of emerging markets, think of those economies and countries that perhaps have got more developed domestic consumers in terms of sectors. Things like agri come up and things like telco. Those are interesting sectors within individual countries. And just try and be diversified. So try and put your money to work in places where perhaps the driver isn't just the tariff story, but our domestic consumers in different parts of the global economy.
So U.S. exceptionalism now becomes just one story to be buying into.
Correct. So that's be diversified. Exactly.
And what are the risks that this may take a different turn? We could see even additional tariffs on China, for instance. Does that change the narrative when it comes to how attractive perhaps the Chinese tech plays are?
Okay, so again, globally, it still continues to be a story about growth. So if we think of the last couple of years, it's been U.S. exception is a story of amazing growth. And we see some worries about that, particularly around things like immigration, which have driven that productivity gain. And we perhaps think there are some clouds over the horizon on that. When we think of China and we think of emerging markets, valuations are particularly attractive. So you have that safety net, that you're buying some very cheap companies, but be active, be an active investor. I think in the last few years, the indices have done incredibly well, having lots of exposure to those big large cap names. Now, of course, looking forward, one needs to be much more thoughtful around the exposure to global policy, to retaliatory tariffs, etc. And one of the key plays, I think, is picking companies that have the opportunity to benefit from the domestic consumer in those various countries.
So valuations is one thing that you look at. The other is policy. And when it comes to policy, everybody's turning their heads towards the Fed. Do these tariffs change the calculation for the Fed? How inflationary do you think the Fed sees this to be?
Great question. So I think there is uncertainty. So I think there is one line of argument that tariffs lead to inflationary pressure on the US consumer. Now, I think that there's some contradictory news. I think certainly the consumer sentiment in the US is perhaps coming down a little bit with the most recent data. At the same time, there's evidence that the US, the companies in the US are looking at more resilient second half of the year. There's some very strong earnings momentum there, which maybe is offsetting that challenge. So I think that at the company level, we have some concerns about tariffs. But again, you want to try and be in those company names where you've got decent valuations and less exposure to that global trend.
So the Fed will stay higher for much longer. What essentially does that mean? First half, no cut, possibility of one in the second half.
Well, so again, I think our house view would be that we're looking at much more muted journey on interest rates. So higher for longer has been our consistent view for a while.
But what's that?
Yeah, well, so that means that, again, at best you see a cut in the second half of the year. Perhaps you don't see a cut at all in 2025, depending on what we see as the data coming through post the tariffs. Again, I would just flag something else. The Fed had a cut of 50 basis points last year, but the long end of the curve went up. So the interactions in the market are a little bit more nuanced, and they need to focus very much on the data and how they might actually drive that policy.
Of course, we've seen a mighty dollar environment, and that is likely to persist. Of course, the dollar is slightly lower today on the back of the tariffs. But when it comes to the dollar and what the Fed is doing, it's really impacting Asian currencies. Talk to us about your own expectations on how the yuan might react.
So there's some narrative around the fact that with tariffs, there might be some pressure on the peg, pressure on the yuan rate. I think that in terms of currencies in Asia, yuan included, I think that this strong dollar has been a challenge on markets and a challenge on investor sentiment in general. This tariff, the dollar, we weren't necessarily expecting a big move in the dollar. If anything, you could argue it's actually good for the dollar, strong for the dollar. It's perhaps helpful that we're seeing the dollar come down a little bit. I think that opens a little bit, but every little bit helps, right? It's a journey. I think the big message here is that markets have been sanguine, waiting for actual things to happen. So the president is effectively talking about he's going to go ahead with them. Now we're reacting, and I think that excess, we've seen a very docile environment up until now. So now we go back to this comment I made earlier, focus on valuations and focus on being very, very diversified.
The thing is, the yuan has been stable because the PBOC has been really active in keeping it stable. We've talked about how the PBOC might want to loosen its hand on the yuan because it needs to reflect the weakness in the economy. But Trump, of course, is against any of that. And we've seen that how Trump is taking issue with the BOJ. So where does it leave the yuan? Where do you see the yuan by year end?
So I think that there is a tension. So I think Trump has very clearly, he's worrying about deficits and worrying about exchange rates and manipulation, as he describes it, of exchange rates. And I think that the yuan, the pressure on the yuan has been that the Chinese government has been very clear that it views the stable yuan and the current exchange rate as being where it's kind of a sign of strength. There will be pressure on that, I think, as we look forward. But I don't see, the house view is not that there's going to be some material move in the near term. So I think it's a stable environment on the currency level.
Okay, so stable for the yuan, but when you take a look at the movements of the loonie and the Mexican peso, that was pretty interesting. They took opposite directions.
Yeah.
We saw the Mexican peso pretty stable, but the loonie was smacked. How do you read that?
There's been an interesting movement. Currency markets have been very, very, very quick to react. So I think that initially, post the presidency, I think initially there's very much a case of the rhetoric of the different governments in how they interact with the US president. And I think, we heard it earlier with your reporters, the Mexican president has been a little bit more nuanced about how they engage. And I think that other countries perhaps less so. And so currency markets react in that way. I would say that...
Rightly or wrongly?
Rightly or wrongly, I think that people currently view Trump as transactional. So this idea is that the kind of soft language and the language of negotiations is something that the markets believe is a good thing.
Okay, now we have to talk about the yen, because Trump did take issue with the BOJ, and the BOJ officials were quick to respond, saying that, we're not doing anything to, to ease the currency. Have we seen the yen bottomed? Is it going higher from here, given all, the stresses that it's facing right now?
I think a long career of timing currency exchange rates perhaps is a bit of a challenge. What we do know is that the BOJ has signaled a journey of rising rates. So it's in a slightly different place, perhaps, to the US. So that, you'd imagine, gives some strength to the yen, and that's the journey. And that might be a soft journey that suits everyone. I think that where Trump is, it's just focused so much on trading partnerships and where that needs to be. I think that when we think of Japan is just a great story. I go back to what I said earlier about valuations and where the domestic economy and those mid and small cap names in Japan, which are focused on the Japanese economy, great place to be. The exporters, we need to worry a little bit more about exchange rates. Again, but I believe that even in a strengthening yen environment, the Japanese conglomerates and the large companies in Japan are just so experienced at dealing with the strong yen. So we can live in hope that is an economy with individual investment opportunities that really are well placed for the coming years.
Before we let you go, just a question of the day that we're asking all our guests. I mean, which asset classes do you think will be affected the most by the tariffs? Yes.
So I think
get
that
hit.
Yeah, get hit. I think that at the index level, there's some challenges for the countries that are being hit by tariffs. I think that one views that as being perhaps a bit of a challenge on growth. And so, of course, risk assets are going to be challenged. Now, that's equities, etc. Now, I think credit is going to have the same issue. I think stake in quality, look at valuations, be diversified. It's the mantra of 2025 so far for us, and I think it's one we would highly recommend for our investors.
And look at valuations. Vis, great to have you with us. Vis Nayar, CIO at Eastspring Investments. Well, still ahead, the Bank of Thailand's Deputy Governor will be joining us after cutting rates twice in 4 months. Our exclusive conversation with Piti, Disyatat, just coming up. Keep it here with us. This is Bloomberg.
We see sort of a, I guess, boomerang effect, or something that that kind of pushes more demand towards China as a result of these tariffs. It's sort of a response, I suppose, to what's been coming out of DC. I think that potentially could help China significantly.
Fastest growing trade routes in the world, US is part of only 2 of them. China is part of 7 of them. China is more prepared for these tariffs, and that's why we've seen, a wait and watch approach. We don't need to react to everything right now. So I do think that the world is going to figure out, it is going to hedge out, and arm twisting is going to take you just so far.
So we see new tariffs being unveiled, right? First it was against Mexico and Canada and China, and then now there is steel and aluminum, and he's hinting at more to come in terms of reciprocal tariffs towards possibly the EU and also Japan. So market really has to brace itself.
Insights from our recent guest on President Trump's looming tariffs in the markets. Well, we have that equity sell-off spreading here in Asia, taking a look at all those benchmarks in China as well as Hong Kong in negative territory. As we await those tariffs to be imposed, of course, Trump doubling down on China, doubling the amount of tariffs as well. The CSI 300 index down 0.3%. The Hang Seng lower by 0.4%. Of course, front and center is also the Chinese yuan. Taking a look where futures are headed in the slightly opposite direction, up 0.3%. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. We're about 90 minutes away from President Trump's levies on Canada, Mexico and China taking effect. Fears of a global trade war are sapping risk appetite, further dimming the outlook for emerging Asian currencies. Errol Hong is here with more, and chances are we haven't seen the worst of the Asian currencies getting smacked.
Yeah, I think there could be even more pressure. I mean, you think about how markets have been running on this idea that for Trump, tariffs are a negotiation tactic, a bargaining tool, right? A way for him to get countries to fall in line. Now with this deadline imminent, it looks like investors are coming to terms with the realities of a global trade war. Of course, things could change, but in the meantime, we've already been seeing markets positioning. You look at this gauge of Asian currencies, which excludes the Japanese yen. It has been reversing the rebound of January. In the past week, it's fallen about 1%, accelerating losses from a 2-month high after Trump spoke about 25% on Canada, Mexico, and an extra 10% on China. Flip the board. In the past week, we've seen the regional currencies, including the South Korean won and the Thai baht, falling about 2%. Now, they've already been grappling with the dollar rally following Trump's election victory. And these fears about global growth taking a hit from not just tit-for-tat tariffs, but this potential from reciprocal tariffs that we don't have clarity just yet on, and how that might pressure what we're seeing in the global economy. So we've seen central banks cutting rates to shore up growth, including last week from South Korea and Thailand. Has.
Errol, thank you so much for that. Now joining Insight exclusively now is Piti, Disyatat, Deputy Governor of the Bank of Thailand. Governor, good to have you with us. I mean, we talk about the threat of tariffs, and now there are bearish calls on the Thai baht, suggesting that perhaps the BOT will be forced to cut rates further because of these tariff threats. I mean, how are you looking at it? Can we expect more cuts from the BOT?
Good morning, Haslinda. It's great to be back. So yes, the tariff is something that we considered in one of our scenarios already. So actually, our latest multi-policy cut is calibrated to be robust, and robust to many scenarios, including this escalation of the tariff. So I think for the foreseeable future, the stance that we have is actually able to accommodate these shocks.
We've also heard from Trump he may escalate some of these tariffs, including that of China. I mean, under what circumstances do you think you'll be forced to cut rates further?
I mean, we've always been outlook dependent, right? And actually, the main reason that we cut rate in our last meeting is because the outlook changed materially to the downside, and that was so going forward. It has to be if the outlook changes in a substantial way. But as I said before, the latest cut is calibrated to be quite robust to many scenarios, both upside and downside risk. So I think it'll take a quite substantial further negative shock for us to reconsider our stance.
You talked about how the outlook changed materially that forced you to cut rates for a second time in 4 months. What changed?
So I would say 3 things in terms of the outlook. First, the latest last quarter, the fourth quarter GDP numbers for last year came in a bit softer than everybody expected. That was partly due to higher imports, as well as a more rundown in inventories than we forecasted. The second has to do with obviously the trade outlook, the global trade outlook. That became more negative. And thirdly, financial conditions in general have been tight, and they continue to be tight, especially in terms of bank credit, as well as equity markets and corporate bonds. The spread has been widening a little bit. So overall, for those 3 reasons, the outlook that we saw for this year used to be around 2.9. Right now, we revised that down to something above 2.5. But so that's the main reasons.
Might you have to revise your GDP target even more? I mean, when you talked about possibly growth in excess of 2.5%, that was based on China getting tariffs of 10%, slept on it. Now that tariffs have gone up by 20%, might you have to relook at your targets as well?
Yeah, no, we had the additional tariffs also in consideration as one of the scenarios. And, I think the effect of the first 10% and the effect of the second 10% may not be like linear. It could be, it remains to be seen how much the extra 10% will have. I think the bulk of the impact will come in already from the first 10%. So at this point, it is within what we had projected as risk scenarios.
How do you think China's economy will be impacted by the 20% tariffs?
Well, they will try to accommodate, to respond. And there's two ways they could respond. One is to try to find alternative markets, and that would affect us and other Asian countries. Second, they may also put in retaliation measures, and that will also affect, the global trade. But in either case, it's negative for the region in general, because even the exports if exports of China goes a bit softer, then we are part of the supply chain. That means we will be indirectly affected by lower demand for Chinese goods, as well as there might be more imports from other countries into Thailand as well.
By affecting Thailand, you mean the dumping of cheap Chinese goods in the country. How badly do you think this will escalate?
Well, we've been importing a lot from many countries, including China. And I think if the price war gets more intense, then there is a risk that the imports will intensify. So we are looking into that. And the manufacturing sector has been going through some difficulties, as you know, especially in the automobile sector. So we'll be watching that quite closely.
So given that the manufacturing sector has already been hit and is struggling to get revived, I'm just wondering what measures can be implemented by Thailand to protect itself from the dumping of cheap products into its own market?
Well, there's a number of measures. First, we need to make sure that the goods that are coming into a country meet the standards that we require in terms of the safety and the quality, and it's all proper. Secondly, the government, we've been trying to upgrade our competitiveness for a long, long time, and this is something that will escalate or accelerate that process. And the many firms and many sectors are already adjusting to that through the way they they produce and outsource or source their inputs. And then we will have to also look at broader our trade and tax policies as well.
There's a lot of pressure from the government for the BOT to cut rates further, and that's on the basis of a weakening economy. Are there other policy tools that the BOT can adopt to help boost economic activity in the country?
Well, apart from our interest rate stance, we've also been looking to try to make sure the exchange rate is not too volatile, that the flexibility of exchange rate works as a shock absorber, but it doesn't amplify the shocks. And another thing that we've been working hard on is on the credit side, to this deleveraging that has been taking place in the household sector in particular. We're trying to make sure that is going on through debt restructuring. And, at the end of last year, we also had, together with the Ministry of Finance and the commercial banks, put in measures to help ease, debt burdens of the fragile groups. So on the credit front, I think we've been trying to do our part in helping firms and households cope as well.
So are you confident? Are you comfortable that the BOT can help the economy get revived?
Well, we can do the most we can with our mandate and our part. And the main focus and our main contribution is to maintain macro and financial stability. And I think the policy setting that we have done has laid the necessary groundwork in terms of stable inflation, financial stability, to allow the restructuring that needs to be done to take place. So I think the the main emphasis, as reflected also in the statement of the MPC this last meeting, is for structural reforms to increase, the competitiveness and lift the underlying potential of our economy.
Governor, we've been talking about the weakness in Thailand's economy, yet in the same breath, we're talking about strength in its currency. The Thai baht, the number 2 currency in Asia in the last 12 months. I'm wondering how you're assessing the dynamics between the two.
Yeah, so the currency has been resilient and robust. And actually, if you look over the last 3 years, not just Thailand, but the Asian region in general has been quite robust to the rather large shocks that we've lived through, the very rapid and big tightening of monetary policy, this trade shocks, and as well as the geopolitical developments. So I would view it as a sign of resilience in our economy. As I mentioned, what we focus on is to make sure that the volatility is not too much, because that translates into cash flow volatility of firms, and that creates uncertainty. The level itself, unless it's really, really way off, we let it be market determined. And so far, on the metrics that we look, most of the movements in the Thai baht is still reflecting fundamental factors. Most of it is actually coming from abroad, the external shocks. But as you know, we do keep a close eye on the exchange rate, because we are a small open economy, and exchange rate is a very important price for the economy.
But doesn't a weaker economy need a weaker currency, especially on the back of the dumping of cheap products from China?
Well, I mean, in terms of competitiveness, you look at the nominal exchange rate and inflation, so the real exchange rate. And in terms of the inflation development, as you know, our inflation rate has been lower than many countries in the region, as well as abroad. So if you factor the two things together, the competitiveness of Thailand is still roughly, hasn't changed that much, because our inflation rate has been lower. So I think that's the metric that determines our competitiveness. And yeah, so far we don't see any major issues with the level of the exchange rate.
Governor, we know that the BOT has had some tension with the government, and we also know that the SET is set to appoint a new chairperson in Kun Somchai. He is seen as a compromise candidate. What are your thoughts on Kun Somchai?
No, I think we are very happy that the process is concluding, and we can have a new chairman and work together. We look forward to working closely with the new chairman. I think this is just part of the normal process. It was delayed a little bit in the past, but we're happy now that we can proceed back to business in a normal way. And the inputs, the conversations we've had with the government, as well as other stakeholders in the economy, is normal. I would say it's a healthy discussion, exchange of views. We do that both at the working level as well as the higher level. And yeah, I think we look forward to just proceeding ahead.
Can you say that the relationship between the BOT and the government has become better, has improved?
No, I think it has always been a healthy relationship. As I mentioned, we at the working level, we discuss exchange our assessment on the economy, on the financial stability, on many issues, structural policies all the time, including this external instability and trade tensions. So I think we've always had a good working relationship, and there's no reason why that should not continue. It has to continue, because we have to work together to maintain macro and financial stability with the government.
Governor, before we let you go, just one final question. That's been quite a bit of optimism from you. I'm just wondering what you assess as the biggest risk for the Thai economy right now.
Well, our biggest risk, I think you can think about the short run and the medium run. I mean, the short run, as you know, there's global volatility, and in terms of the trade uncertainty is the most, I guess, dominant factor right now as a risk factor for our economy. But in the medium and longer run, I think the key thing is our underlying structural problems that we've had in the economy. To lift the growth potential that I mentioned, we need to do some serious structural reforms, and that is like, I think, the more first order issue at the end of the day.
Governor, thank you so much for your time. Piti Disyatat, Deputy Governor of the Bank of Thailand, we thank you so much for joining us today. India has been trading for about 30 seconds, just kicking off its trading day. Let's take a look at how it's looking for India as Asia sees a sell-off in equities spreading on the back of those Trump tariffs happening in just a matter of hours. The Sensex index currently down by 0.5%. We're also seeing losses for the Nifty index. And by the way, the Nifty index is just nearing that bear market territory. It nears its bear market territory in about 5 years. The Nifty benchmark is down more than 6% year to date. And of course, we've been talking about that outflow of foreign money, and that continues, and that's amid concerns about a sluggish economy. Remember that this is one economy that grew at about 8% now, in excess of just 6%. Ain't too shabby for most countries, but for India, it's down from more than 8%. Well, still ahead, Asian countries beyond China are bracing for the impact of the Trump tariffs. SM Investments Erwin Pato will be joining us next with insights on the Philippine economy. Keep it here with us. This is Bloomberg. The world is watching President Trump's trade policies closely, and the Philippines is no exception. The U.S. was its top trade destination last year, accounting for 17% of exports. Let's get the outlook from the Philippines' largest conglomerate by market value. SM Investments is the holding firm of the C family, the richest in the Philippines, which owns banks, shopping malls, property developments, and a host of other portfolio investments. The conglomerate is often seen as a proxy for the Philippine economy. Erwin Pato is Executive Vice President for Treasury, Finance and Planning at SM Investments and joins us here in Singapore. Good to have you with us, Erwin.
Yeah. Good morning, Haslinda.
When I read reports on Philippine economies and the companies there, they seem to be pretty upbeat that the Philippines can escape pretty unscathed when it comes to Trump tariff impact. I'm just wondering how you're assessing it.
Yes. Thank you for that question. I think the upbeat view is really because if you're going to look at the Philippine economy, we're really domestic driven. Our GDP is 70% consumption driven. And if you're going to look at the last 20 years, our GDP has grown steadily from 47%. And if I can recall, and there's only 1 year that was in negative growth, and that was during the pandemic, but it also bounced back. So I think the hopefulness, if I may, comes from that knowing that that strong base is something, a consumer base will support us.
But even the government has acknowledged the possible impact. It widened its GDP projection to 6 to 8%, citing the uncertainty of the impact of tariffs. I mean, where could the pain points be for SM Investments?
Yes, maybe I can answer that broadly first. So the Philippines is a net goods importer, including food and energy. So in terms of tariffs, being in the radar of the U.S. directly, probably we're not the biggest market for them. But if the bigger economies do have tariff wars and concerns with it, secondary effects may go to the Philippines, and those secondary effects may come across around exchange rate, i.e. the peso being weaker, which can be inflationary because we are net good importer, and of course the disruption of supply chains. But I have to credit our economic managers because, let's say, for example, our gross international reserves, the normal would be 3.5 months coverage. I think we have around 7.5 months. So that's a very strong tool that they would have to make the peso stable. But if so, that will flow through. And that is something that being a consumer-driven economy, if it flows through inflation, purchasing power may be affected.
For SM Investments, China is a key market. We know that growth has been sluggish, and we also know that you have plans to build more malls there. I'm just wondering, what kind of investments and what kind of prospects are you anticipating from the Chinese market?
Yes. So for China, it's an important market for us. We do have around 6 malls there, but our investments in China through our mall network is largely self-contained. It is growing on its own accord. Last year we had 3% growth. But our real focus really on the business of malls is in the Philippines, because that is where the growth is. And even with tariffs, we feel that the growth in the Philippines in the next years will really be driven by consumption.
Yeah. And the other thing that I want to touch on is actually the gaming business. We know that you've indicated Malco might pull out from City of Dreams. I mean, what might the alternatives be? Could your unit be taking over that operation?
Oh, so for us, our focus is really our core businesses. And the core businesses that we are focused on is our retail, our property development, and our financial services. Those are our focus because within the consumption-driven part of the economy, our footprint there gives us the best way to create long-term shareholder value as we continue to expand our nationwide coverage.
But in terms of City of Dreams, what's the plan there if Malco were to really pull out from the operation?
It's a growth. I suppose it is an attractive business. It's something that others may go into, but our focus really is more of our core businesses.
Okay, I was hoping to get more. Erwin, thank you so much for that. Erwin Pato, SM Investments. Now a quick programming note before we go. Let's take a look at what we have in store for you. Of course, we have a full lineup of guests coming right up. Also, Bloomberg will have special coverage tomorrow of President Trump's address to a joint session of Congress. At the times on your screen, Insight will be back later this week with exclusive interviews from ARM CEO Rene Haas, and Malaysian Prime Minister Anwar Ibrahim will also speak with PGIM Real Estate Co-CEO Kathy Marcus and Trip.com CEO James Sun. So plenty to watch out for as we take a look at the rest of the week. That is it for Insight. Horizons Middle East and Africa is next to keep it here with us. This is Bloomberg.